Joseph, people are calling you the Fed Whisperer in here. Welcome back to Face.
Hey Dale, thanks so much for having me. It's a pleasure to be here.
So, do you like that moniker, the Fed Whisperer?
I think that's very generous. I think it's taken already. I'm happy with Fed guy.
Stick with your handle. So, I wanted to talk to you today about, the last thing that you were writing about, because what's happening with the banks is very important in some of my narratives. So, your last article is talking about dollar deleveraging, and you made the point, this is on your free letter, that foreign banks are actually under more duress than the regionals. And the regional, it's hard to imagine when I look at the regional chart, the KRE, that these banks are under more pressure than the regionals. Is it because they have the duration book that the regionals had? They're underwater and out of long bond positions from the COVID days when rates were so low. The last time they were that low was the first Civil War in the US.
So rates have gone up a lot. I think another point that's worth mentioning is just the profitability of how these banks work going forward. So as we all know, banks have short-dated liabilities and longer-dated assets, right? So when rates go up, well, that could in some cases squeeze their net interest margins because their short-dated liabilities reset higher than their longer-dated assets. Now that's the theory, but in practice, that really impacts banks very differently. If you are Bank of America or JP Morgan, for example, I mean, the Fed could hike rates 5%, and you're basically still offering your depositors something close to zero, and your depositors take it. You offer great services, you're too big to fail, and people just kind of accept lower deposit rates. So it doesn't really affect you that much. When you go down the ladder to the regional banks, you see them trying to pay up a little bit more on their deposits. So that's squeezing their net interest margins, so making them less profitable. But now when you move out abroad, when you're looking at foreign banks, well, that's a completely different ballgame because foreign banks, they don't really have a lot of retail depositors. If you're if you're in Thailand or if you're in Japan, there are people with dollar deposits. They're just not mom and pops. They tend to be corporations and institutional investors that are active in international trade or finance or something like that. So these guys, they want market rates. So when you go out of the country, and the way that the dollar works, it's a global currency. So you have a lot of foreign banks with big dollar loan books making dollar loans to international corporations. So those guys, they don't have retail deposits. So when the Fed hikes rates, their funding costs really do go up to around 5%. And that's really squeezing their margins. And you can actually see them delevering. So their dollar loan book is shrinking at the fastest pace since the 2008 great financial crises. In the US, we see that banks have basically, slowed down their loan growth on aggregate to very, very, very low levels, but they haven't actually contracted. But you see outright contraction when you look outside of the country. And that's going to squeeze a lot of these foreign companies. And it's going to be it's going to be a headwind for international trade because let's say you're a company in Thailand or India or something like that, and you need to participate in international trade, you need dollars to do that. Dollars are basically the currency of trade, they facilitate international commerce and so forth, and now it's less available. So I think that's a headwind, and probably why you see there's this global manufacturing slump if you look at the PMI data. I think part of it is because a lot of companies, they can't get the financing that they need.
Okay, so I mean, it's not only regionals. Here's Goldman. So
No,
I mean,
I want to be clear though. This is the dollar banking business of foreign banks.
okay,
It's just
all
a
right,
small part of their overall business. So it doesn't mean that they're not doing well or anything. It's just that they're
okay,
one aspect of their business.
is under pressure. Okay,
Yes, that's right.
all right, okay. So obviously, not just the rates, but what has gone hand in hand with the rates has been a relentless move in the dollar to the upside, Joseph.
Yeah, I
We
was
have the
listening to you guys' discussion.
look
So
at that. I mean, since the bottom, we've had very, very few pullbacks. To me, this is pretty relentless. I know a lot of people are bearish a dollar,
I'm super
even
bullish
through
though.
this.
Super, super bullish.
I figured you would like this chart today.
It's been a painful topic for a few months, but
Yeah, I
finally it
mean,
looks like it's spurting up.
well, you
So
know,
actually,
this whole process took time. Everything takes longer than you think it's going to take, doesn't it?
so the way that I think about this, I think that so last year, right? So we had
Yeah,
significant dollar strength since the Fed was hiking so much more aggressive than everyone else, and that I think that policy divergence made the dollar shine. I think we're about to see the return of that, but in another way, in the sense that the Fed is going to be so on the way up, the Fed hiked much more than everyone else. On the way
yeah.
down, the Fed is going to be much slower to cut than everyone else.
Okay.
The reason simply has to do with how policy works internationally. So in the US, oh, well, there's a few things, moving parts. So in the US, Fed hiked, probably going to hike one more time. Um, the
Do you
economy
think
still
it'll
is
be
doing,
this month? This
no,
month?
it's probably going to be December, I think.
Okay.
Um, so even though the Fed hiked aggressively, the US economy is still doing really well. We're still growing above trend. And we have been for the past 2 quarters. And it looks like this quarter we are going to do even better. We have strong fiscal deficits that are supportive of the economy, but we also have an economy that's just not as interest rate sensitive. I mean, think about households. We all have 30-year mortgages. That's
Yeah,
totally not the case for many other countries. If you look at Canada, for
good
example,
point.
you know, those guys they're under a lot of pressure. Why? I mean, their mortgages reset within
They've
5 years, so a
doubled.
lot of people. Yeah, and you can actually see the political pressure being built. So Steve Sardinsky has a really good Twitter thread where he's showing that the premiers of a few provinces in Canada are writing letters to Tiff Macklem, the governor of Bank of Canada, basically begging him to not hike rates. So they're basically maxed out. It
That's
doesn't seem like they're
today.
going to.
Today,
Yeah,
POC,
yeah. So
right?
I don't think anyone thinks they're going to hike anymore, right? Their
Well,
GDP numbers last time were negative, so and they have political pressure, so it's probably not going to happen. So
okay.
they're probably done, and they're probably going to have to think about cutting in the coming months. And I can think you can make the same case for the UK, and probably to the eurozone. The eurozone is a bit more complicated because it's more of a political aspect. But I think that if you look at data for some of the big Eurozone countries, it's very clear that countries like Germany are not doing well. So they really can't handle rates the same way the US can because their economies are more sensitive to it. So they're going to have to
Yeah,
stop and they're going to have to cut first. So as that
interesting.
happens, I think the interest rate differential is going to widen between the US and others, and we'll see the replay of what happened last year with the dollar continuing to strengthen.
Do you have levels where you would be looking for maybe
So
euro near term? Huh?
I'm gonna have to I'm gonna have to definitely defer to the guys
Okay.
here. I mean, you guys do the
All right.
technical stuff. So I
But
was
you
thinking,
think there's
yeah.
duration? But what you're saying is this is not going to be a flash in the pan move from mid-July to now, but this is going to have legs at least in time,
Yeah,
correct?
I think it's gonna persist for the next few months.
Okay,
So again, things change, right? But
right.
from what now it seems like just looking at how our respective economies are doing and how monetary policy works, I think it's going to I think it's going to play out for a few months at least.
Okay. All right. So another article called Adrift at Sea. Is that you and me or the US or the Fed? Who needs a lifeboat?
So, this is talking about interest rates. So, I've been very, very bearish on bonds. So, I've been thinking interest rates would be structurally higher. Been writing about this for some time, and I think we're seeing this happen. So, there's two things driving this. The one that I've been focusing on in the past really has been supply. I mean, basic demand,
Oh,
right? Supply and demand.
yeah,
Just
yeah.
tremendous amounts of supply, and I think the market is catching on. We had an article in a generic mainstream publication, the Washington Post, talking about fiscal deficits. Now that's one thing, and that's definitely an upward pressure for interest rates. But the second thing that I think it's a little bit new is that for the guys who are more fundamentally minded, guys who care about things like neutral rate and inflation expectations, and I'm not even sure if there's that many people who really look at the world that way. Those guys are changing their mind as well. And there's a couple of things pushing them to change their
Are
mind.
those the bond vigilantes from the 80s that their kids
I
are
think they're
carrying the
just,
torch?
I think there's old school
Yeah,
macro guys from another generation. So
yeah.
if you look at
Like
interest
like
rates,
me,
so
old school
I don't
guy,
know
huh?
I don't know how you look at things.
Okay. Anyway, I know.
So
I'm in the
if
tar
you
pit.
so those guys, they think about rates as, neutral plus inflation expectations as longer dated rates. Now, both of those things, I think, are being adjusted higher in market pricing. If you think about the neutral rate, Fed traditionally thinks of it as 2.5%, but it's very obvious that Fed raised rates 5% and the economy didn't really slow. So a lot of people are beginning to think that maybe the neutral rate is higher. If the neutral rate is higher, then interest rates have to be higher structurally going forward, and that feeds out into the 10-year.
Okay.
The next thing, of course, is inflation expectations. Now, there's a lot of noise, some really important people thinking that maybe we should raise the inflation target. I don't know if that's going to happen, but I know if that it happens, it's going to begin with a lot of important political people making a lot of noise, and that's happening now. Now, so if you're someone who's buying a 30-year treasury bond, you have to think to yourself a little bit, maybe within 30 years, and 30 years is a long time, maybe the Fed adjusts their inflation target, maybe to 3%, 2 to 3%. Now I have to price that in a little bit, right? Because if I get this wrong, it's a lot of money. It's 30 years, a lot of duration there. So I think those things are happening as well, and that's going to put upward pressure on interest rates.
I'm more the long end, and that would be a segue into your steepening stance that
I think the
last
Fed is
week.
steepening.
Okay, because the long end is where they came out with most of the new supply a month ago, right?
Tons of factors, those two things that you just mentioned and we just discussed. But the Fed, I think, is trying to steepen the curve as well. How are they doing this? I think they're doing this because they're talking about not letting QT continue even when they start cutting rates next year. Now, usually you would expect the Fed to, not if they're cutting rates, you don't want to do QT, right? You want your balance sheet and your overnight interest rate to move in the same direction. You don't want to press on the gas and the brakes at the same time. That's traditional Fed thinking. But they're changing their mind now. They're saying that, maybe these we can do these two things at the same time. And so next year, when the Fed is going to cut rates a little bit because inflation has come down, they're talking about letting their balance sheet continue to shrink. Now, cutting rates is, of course, making the shorter term rates lower, and letting QT continue is putting upward pressure on longer dated interest rates, right? So that's a steepening posture. And so I think that's what the Fed wants.
So what will bears hang their head on, since they've been pointing towards an inverted curve for a few years now as being
the
pretty
Bears
reliable, huh?
Well, the Bears who have been bearish on the U.S. economy have been not just wrong, but ridiculously wrong, because the U.S. economy is not just going above trend, it's accelerating. Okay, so accelerating to the upside is the complete opposite of going into a recession. So I think they're probably going to be wrong on this again. So I don't think the inverted yield curve tells you anything. Tells you a lot. The world in the future is not going to work the same way as the world did in the past.
Any view on equities? Looks like there might be a little failing rally here in the S&Ps.
I think I think the highs are in for the year. I don't think we're going to crash, but I think that as yields go higher, I think that's going to put a cap on equities. You see that? So I want to be clear. So yesterday, price action was really confusing to me. We had markedly higher yields, the 10-year up 9 basis points. We had the dollar strengthen, but equities seem really resilient. So there could be some flows related to OPEX. This month is a major September OPEX. Maybe that, I'm not too sure. But the equity market does seem to pretty resilient to me. I don't think we're going to make new all-time highs or even make new annual highs, but I don't think we're going to crash. There just seems to me a lot of surprising strength there.
Oh yeah, I mean, look at all the headwinds it's faced, Joseph. And I know I've fought the S&Ps quite a few times this year, but I mean, you look at the 10-year, we're back at the October highs. Okay.
Yeah.
You have currency situations like the yen, we're almost back at intervention levels at October. You have the yuan at those levels, that's where the S&Ps bottomed in October. So you've had all these markets retraced to what was a critical low in the S&Ps, and the S&Ps have fought these headwinds all the way up. It's amazing to me.
It's amazing to me as well. I would not have expected this, but it just seems like there's a lot of strength there.
Okay. Well, we'll see. Most people are in the correction camp. I could see their reason, maybe around 41, 4,200, a little bit more of
Yeah,
a pullback in your view.
yeah. I think that's the exact phrasing I would think a pullback, but not a crash. And
Oh, okay.
yeah,
Does this make the Fed's job a little more difficult? I think on Labor Day, gas prices were the highest that they were in quite some time because we never really, I don't know, they could blame it on refineries or whatever. We never got huge price reductions on the break in crude. Uh, a lot of people are calling this a breakout that we could be headed for 95 or $100 crude. What does that do to the Fed's formula here?
it makes the Fed's job a bit harder, right? So, I mean, we could see inflation reaccelerate. Now, the Fed tends to look at core inflation, which doesn't include these energy prices, but they'll have to pay attention to it if it's too high. And I think you raise a really good point about oil. So, when I look at these markets now, I think we have to take more and more into consideration global politics because obviously there's an economic war going on, right? Right. So
Yeah,
when
there
inflation
is.
was high, you had the Biden administration basically emptying out the SPR to try to get oil prices lower, right? That's a big political actor trying to push oil prices low. Now you had the OPEC, especially the Saudis, fight back, right? They are restricting output, them and the
Right.
Russians, and trying to get oil prices up. So there's an economic war going on, and it's not just in these oil things like as well. We have to look at the big global economic relationship, the U.S. and China. Very
Yeah.
obviously, the
Chips.
U.S. is trying very hard to just kind of poke the dragon, and so the dragon actually
And,
also has options to fight back as well.
and they
One very
haven't,
obvious,
and they haven't yet, except in
well,
language.
I
What
don't
do you
know.
think they're
So
going to do?
a
They
very
they have
obvious thing to
leverage.
do, a very obvious thing to do, of course, is their huge holdings of treasury securities, right? They can make interest rates go up a lot by just kind of selling them a bit. So if this conflict is long lasting, if you think about it from the Chinese perspective, obviously I can't be holding a lot of US debt or even US dollars because what happened to the Russians could happen to me. That's a huge vulnerability. So structurally speaking, they have to get out of this trap somehow. And so for them, I think the most obvious tool that they have to fight in this economic war is their influence on U.S. interest rates through this tremendous treasury holdings. Now,
They're
all
not
that
holding
stuff,
as much. I've seen chart.
I would be careful. I would be careful
uh,
about interpreting that data because
Okay.
that data is going to be based on market values. And as we all know, there was a big bear market in bonds last year, right? So that's going to
Yeah.
make the prices of bonds go down. So I would not, I would be careful about that. So it's hard to know what actually the Chinese hold. It's a state secret for them.
It's
We
still
could
a
try to
bear
piece
market.
we could paste together some stuff indirectly, but it's a state secret as to what they hold in their foreign reserves. Um, but hey, this is a tool that they have that they can use against the US in this economic war that is happening very obviously, right? That sanctions, you got all these export restrictions. And now the Chinese, I saw a headline today that they're telling their government agents to not use iPhones just in the same way. The US doesn't like anyone using Huawei. So this is happening. And
Oh,
their obvious
good.
tool to me, of course, is
Yeah.
interest rates.
Short Apple. Anyway, I wanted to wrap it with, you said we were in a bear market. This rally or stabilization in the bonds, and you know what? I have to thank you, Joseph, because there are a few times I was thinking about bottom picking it for more of a bear market rally, and you would shake your head at me. No. Okay.
So I
And
think we get to 4.5 on the 10-year by the end of the year. I think we
okay.
can see 4.5. But listen,
Okay.
if you want rates, so this is what I like. So I think agency MBS are better than treasuries because for one, they're yielding more. Secondly, I think that the spreads between agencies, MBS, and treasuries are probably going to tighten because since mortgage rates went up so much, we have a lot of people who there's not a lot less supply, right? People are not getting mortgages at the same rate they used to. The supply is going to the supply, and I think people are still betting that soon we're going to have rate cuts and there's going to be this big wave of refinancing. And so that's being priced into the prepayments and mortgages, but I'm not sure that's going to happen. We might stay higher for longer in that sense. So some of the mortgage REITs, I think, are offering maybe 10 to 15% yield. And if the curve does steepen,
Wow.
so the Fed cuts short rates and maintains QT, and I think that it'll play out well for those businesses.
Okay, I just wanted to see if you could answer this question. I don't know if I asked you last time, but why do people have more confidence in junk? Look at that chart, and less in corporates and TLT. So why is HYG, why does it have such a better looking structure and is held together better than sovereigns or corporate grade A, investment grade corporates?
My sense is that the junk stuff is shorter duration, so it's not as impacted by interest rates.
Okay.
That's probably why.
People have a feeling they have a higher percentage of getting paid by, issuers of junk than our own
Well,
government
to be clear,
and
credit
corporations.
credit 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 is doing well. Spreads are, within historical ranges. Defaults are low. They're rising, but they're still around historical ranges. So there doesn't seem to be any credit problems in U.S. businesses at this moment.
Okay. I wanted to show your website,
Great.
so that, people know where to go. So it's Joseph Wang. Let me just go to my profile and we'll get it there. Okay. Okay. So Joseph, you also have a course. All right. So
Yeah.
here's
So my website is fedguy.com, and I mean I also I have weekly blog posts about what I think is happening in the markets, what's interesting. From the perspective of a financial system, I have a bank, Central Banking 101, bestseller on Amazon, talking about how the financial system works. And I also have online courses called at my website, centralbanking101.com, where I talk about more teach about different macro asset classes. So if you're interested in having just more of a foundational view on just global macro, check it out. Some of the courses are free.
okay. And, to most people, what central bankers do is voodoo. So Joseph brings it out into the light so you can have an understanding as a layman. So like always, Joseph, thank you very much for, sharing your views with us and edifying the FACE community. I appreciate it and wish you good fortune going forward.
Thanks, Coach. Happy trading, everyone.
All right, Joseph Wang, everyone, follow him at FedGuy12. Adios, and you could join the team in about 15 minutes on the Morning Edge. Thank you again, Joseph. Adios, everyone. See you tomorrow. Don't just count your pips, count your blessings.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.